Today, we're diving into financial statement analysis, a crucial skill for understanding any company's health. This process helps us truly understand a company's financial story and its overall business performance. Let's begin by exploring the core purpose of ratio analysis, a powerful tool in financial evaluations. We'll uncover why we specifically use financial ratios to gain deep insights into a company. First, ratio analysis is vital for performance evaluation, helping us gauge a company's success. It assesses how well a company performs across profitability, operational efficiency, and its ability to meet short-term obligations. Next, ratios are critical for informed decision-making, guiding investors, creditors, and management effectively. They provide crucial insights, empowering investors, creditors, and management to make well-founded financial decisions. Finally, ratio analysis is excellent for benchmarking, allowing us to compare performance against industry standards. This involves comparing the company's performance against industry averages or its key competitors for context. Now, let's focus on liquidity ratios, which measure a company's short-term financial health. These ratios are essential for assessing a company's ability to meet its immediate financial obligations. Our first liquidity ratio is the current ratio, a fundamental measure of short-term solvency. The formula is straightforward: current assets divided by current liabilities, giving us this key metric. For example, with current assets of 1,20,000 rupees and liabilities of 80,000 rupees, the ratio is 1.5. Next, we have the quick ratio, also known as the acid test ratio, for a more stringent liquidity test. Its formula is current assets minus inventory, all divided by current liabilities, excluding less liquid assets. With current assets of 1,20,000, inventory of 30,000, and liabilities of 80,000, the quick ratio is 1.125. Moving on, let's explore profitability ratios, which show how effectively a company generates earnings. These ratios are crucial for measuring how effectively a company generates profit from its operations. First up is the gross profit margin, indicating the percentage of revenue remaining after cost of goods sold. The formula is straightforward: gross profit divided by sales, which is typically expressed as a percentage. If gross profit is 50,000 rupees and sales are 2 lakh rupees, the GPM is 25%. Next, we have the net profit margin, showing the percentage of revenue left after all expenses. Its formula is net income divided by sales, which provides a clear picture of ultimate profitability. With net income of 30,000 rupees and sales of 2 lakh rupees, the NPM is 15%. Finally, return on equity, or ROE, measures how much profit a company generates for shareholders. The formula is net income divided by shareholders' equity, reflecting efficiency in using invested capital. If net income is 30,000 rupees and equity is 1,50,000 rupees, ROE is 20%. Now, let's explore efficiency and solvency ratios, crucial for understanding operational effectiveness and long-term stability. These ratios reveal how well a company uses its assets and effectively manages its debt obligations. The inventory turnover ratio tells us how many times inventory is sold and replaced during a period. It's cost of goods sold divided by average inventory, measuring how efficiently a company sells its products. Next, the accounts receivable turnover ratio indicates how quickly a company collects its credit sales. This is net credit sales divided by average accounts receivable, showing the efficiency of collection processes. The debt-to-equity ratio reveals the proportion of debt a company uses to finance its assets. Its total liabilities divided by shareholders' equity, providing insight into the company's financial leverage. Finally, the interest coverage ratio assesses a company's ability to meet its interest payments. Calculated as EBIT divided by interest expense, it shows how easily a company can cover its debt costs. Let's conclude by understanding what is trend analysis, a powerful technique in financial review. Trend analysis involves examining financial data over multiple periods to identify patterns, trends, and anomalies, crucial for forecasting and decision-making. Let's explore the different types of trend analysis, which are crucial tools in financial statement examination. These are various methods to effectively examine and understand financial data as it evolves across different time periods. First, we have horizontal analysis, a powerful technique for understanding changes in financial data over time. This method compares data across several periods to clearly identify whether there's growth or a decline in performance. The formula is current period amount minus base period amount divided by the base, then multiplied by 100%. Its main purpose is to evaluate the absolute growth or decline of financial items over specific periods. Next, let's look at vertical analysis, another essential tool for understanding financial statements. This technique expresses each financial statement item as a percentage of a chosen base item within the same reporting period. The formula for vertical analysis is item amount divided by the base amount multiplied by 100%. Its purpose is to analyze the composition of financial statements and understand each item's contribution. Now, let's delve into the crucial purpose of comparative analysis in understanding a company's financial health. Understanding why external comparisons are so important helps us gauge a company's performance against others. One key purpose is benchmarking, where we measure performance against industry standards or key competitors. This involves comparing your company's performance against established industry standards or direct competitors. Another purpose is performance evaluation, assessing how well a company performs relative to its peers. Here, we evaluate exactly how well a company performs when compared to its similar industry peers. Comparative analysis also plays a vital role in strategic planning, informing key business decisions. By making these comparisons, we can inform and refine strategic decisions for the company's future. Finally, it's essential for investment decisions, providing valuable insights for potential investors. This analysis offers crucial insights to investors regarding a company's competitive standing and potential. Let's explore the various types of comparative analysis, each offering a unique perspective on financial performance. These are different methods to effectively compare financial performance, providing a comprehensive understanding of a company. One type involves comparing a company against different companies, often its direct competitors. This helps us evaluate how a specific company's performance stands in relation to its direct competitors. Here, you'd compare key metrics like revenue, net income, profit margins, and various financial ratios. Another important type is comparing a company's performance over different periods of time. This allows us to assess changes in financial performance and identify trends across various reporting periods. We analyze trends in key areas such as revenue, operating expenses, and ultimately, net income. We also perform industry comparison, evaluating a company against broader industry averages or benchmarks. This helps evaluate a company's performance by comparing it against industry averages or established benchmarks. You compare key financial ratios of your company with the standard ratios for that particular industry. Finally, there's peer comparison, focusing on direct competitors within the same specific sector. This involves comparing performance specifically with direct competitors operating within the same industry sector. Here, we use various ratios and financial data to assess profitability, liquidity, and operational efficiency. Let's summarize the key insights we gain from applying these powerful financial analysis techniques. Now, let's bring all these concepts together to understand their combined impact on financial understanding. Ratio analysis helps us assess specific aspects like liquidity, profitability, efficiency, and solvency using calculated ratios. It thoroughly assesses specific aspects such as liquidity, profitability, efficiency, and solvency using various calculated ratios. Trend analysis identifies patterns and changes in financial data over multiple periods, crucial for forecasting. This identifies patterns and changes in financial data over several periods, which is vital for accurate forecasting. Comparative analysis benchmarks performance against peers or industry standards to evaluate relative standing. It benchmarks a company's performance against its peers or industry standards, evaluating its relative market standing. Let's quickly review the main points and key takeaways from our discussion on financial statement analysis. These are the essential key takeaways you should remember from our comprehensive discussion today. Remember, financial statement analysis effectively uses ratios, identifies trends, and makes crucial comparisons. Ratio analysis is vital for evaluating a company's liquidity, profitability, operational efficiency, and overall solvency. Trend analysis helps identify patterns in financial data over time, which is essential for forecasting future performance. Comparative analysis benchmarks a company's performance against its competitors and the broader industry. Ultimately, these powerful analyses inform strategic decisions for both investors and the company's management.